Whether you're managing a household budget or trying to balance a stock portfolio, everybody is really chasing the exact same holy grail.
Right, which is stability.
Exactly. You want the bills to be predictable
Yeah.
and, you want the income to be rock solid.
Oh, absolutely. I mean, just human nature to want that financial floor under your feet. Nobody enjoys opening a credit card statement to find some jarring surprise.
Definitely not.
And Wall Street investors, well, they certainly recoil when a company's earnings suddenly fall off a cliff. We inherently crave predictability.
But the reality of the open market is that true predictability is incredibly rare. I mean, markets fluctuate, consumer tastes pivot, and global crises throw everything into chaos.
Yeah, that's the nature of the beast.
Today, though, we're looking at a company that's trying to engineer absolute total stability. We're taking a deep dive into Spire Inc., specifically their second quarter fiscal 2026 update presentation.
Right.
And they just released this on May 6, 2026.
Yeah, and Spire, for those who don't know, is a sprawling natural gas utility. And what this presentation outlines, it isn't just your standard quarterly financial update.
No, it really isn't.
It's honestly a masterclass in aggressive risk management.
So our mission today, for you, the listener, is to decode this corporate presentation. We're going to explore how a major utility is fundamentally changing its corporate DNA to just completely eliminate free market risk.
Which is fascinating.
It really is. We'll look at how they managed to fund billions in underground infrastructure without causing a total customer revolt.
Always a tricky balance.
And most fascinating of all, we'll see how they fight back and actually win when Mother Nature herself messes with their bottom line.
Okay, let's unpack this because Spire is currently in the middle of a fundamental identity shift.
They really are.
Yeah.
They're essentially rewiring how their entire business operates.
Yeah.
You could almost call it a great corporate swap. They are actively shedding certain types of high-risk business models while at the exact same time absorbing others that fit a very specific conservative profile. Well, let's look at the numbers because they are just staggering. Spire just closed a $2.48 billion acquisition of the Piedmont Natural Gas Tennessee business.
It's massive.
That is an enormous buy. It adds over 200,000 customers and a $1.6 billion rate base to their portfolio.
And that term rate base, that is the key to everything here.
How so?
When we talk about a rate base, we're talking about the total value of the physical property.
Yep.
So the underground pipes, the meters, the facilities, all the physical stuff that regulators legally permit a public utility to earn a specified profit on.
Got it.
By adding $1.6 billion to their rate base, Spire is expanding the physical foundation that literally guarantees their future earnings.
Okay, but at the exact same time they're buying up Tennessee, they are hosting this aggressive corporate yard sale.
Yeah, they are.
They closed the sale of Spire Marketing on April 30th, 2026 for $212 million.
Right.
Then they're selling off Spire Storage to I Squared Capital for $600 million in cash, plus another deferred $50 million down the line. And on top of that, they're unloading Spire, Mississippi to Delta Utilities for $75 million. So they buy sprawling utility operations in Tennessee and sell off marketing, storage, and certain Mississippi assets.
Exactly.
The stated goal here is to transition the company into a purely regulated gas utility mix alongside a FERC-regulated pipeline.
If we connect this to the bigger picture, you have to understand the fundamental friction between a regulated utility and a non-regulated energy business.
Right, because they are very different animals.
Completely different. Operations like Spire Marketing or Spire Storage live out in the wild. They operate much closer to the open free market.
Which means lots of volatility.
Exactly. Their revenues can swing wildly based on, the daily price of natural gas, supply chain bottlenecks, or sudden spikes in global demand.
Yeah.
Like if you run a storage facility, you're trying to buy gas when it's cheap in the summer and sell it when it's expensive in the winter.
It's just arbitrage.
It's arbitrage. It's inherently volatile.
Which means they could have an incredible year if the market plays along, but they could get absolutely crushed the very next year if the market just decides to turn.
Spot on. The earnings chart looks like a roller coaster. But a regulated utility operates under a completely different set of rules.
Right.
In exchange for providing a critical public service, making sure natural gas reaches millions of homes, the government grants them a local monopoly through public service commissions.
Okay.
The trade-off for that monopoly is that their profit margins are capped. They can't price gouge.
Makes sense.
But the benefit for the company, though, is enhanced earnings visibility. By shedding those volatile storage and marketing arms, Spire is intentionally getting off the roller coaster.
You know, it's like trading in your highly volatile tech stocks and your risky weekend side hustles to go all in on government bonds.
That's a perfect analogy.
You're voluntarily giving up those wild, unpredictable highs. But in return, you get a steady, guaranteed paycheck that hits your bank account every single month without fail.
It's a strategic retreat from risk. They're buying predictability by expanding their footprint across state lines.
Right.
Moving into Tennessee also diversifies their regulatory risk. If the Missouri Utility Commission is being tough on rates in a given year, a friendlier regulatory environment in Tennessee or Alabama can balance out the balance sheet.
But does simplifying the business actually guarantee stability? Because looking at the data in this presentation, it seems like even with a perfectly regulated, geographically diverse business model, there is one monumental variable you simply can't regulate:
Oh, I know where you're going with this.
the weather.
Yeah, Mother Nature always has a vote.
And this brings us right to their operational reality in the second quarter of fiscal 2026. Missouri experienced a very, very mild winter.
Unseasonably warm.
Yeah. The industry metric they use is heating degree days, or HDD. For the first half of fiscal 2026, the heating degree days in Missouri were 11.5% below normal. It simply wasn't cold.
And the mechanical reality of that is simple. If the temperature doesn't drop, families don't turn up their thermostats.
Exactly. This lack of cold weather caused residential gas usage to drop materially below historical patterns.
Which hits the bottom line.
Hard. The financial fallout for Spire was a $28 million pre-tax volumetric margin shortfall. They missed out on $28 million of expected profit purely because it was too warm outside.
Wow.
And to make matters worse, recent Missouri rate designs actually shifted more of the revenue recovery directly into the winter heating season.
Oh, man. So by regulatory design, Spire was even more vulnerable to a warm winter this year than they've been in the past.
Exactly. The structural setup made them hypersensitive to the weather precisely when the weather decided not to cooperate.
Talk about bad timing.
Wait a second, let's look at this from the outside for a minute.
Sure.
If a ski resort doesn't get snow in December, they just lose money. They might lay off seasonal staff or have a terrible quarter, but that's the risk of doing business. But Spire didn't just accept this $28 million loss. The presentation shows that in March 2026, they filed something called an Accounting Authority Order, or an AAO, with the Missouri Public Service Commission to recover this lost margin.
Yes, they did.
Why does a natural gas company get to file state paperwork to recover lost profits just because the sun was shining?
What's fascinating here is the fundamental difference in how society views a ski resort versus a public utility.
Okay, lay it on me.
Well, a ski resort is a luxury operating in a free market vacuum. If the resort goes bankrupt, it's unfortunate for the skiers and the owners, but, society keeps functioning.
Sure.
A natural gas utility, however, is the definition of critical infrastructure.
Right.
People rely on it to survive the winter.
You can't just let municipal gas pipes rust in the ground because we had a mild December.
Exactly. Utilities are bound by what we call the regulatory compact.
Okay.
The state mandates that the utility must provide safe, reliable service to every single home, and they must maintain billions of dollars in underground infrastructure.
Regardless of the weather.
Right. Regardless of whether it's the coldest winter in a century or unseasonably warm, the cost to inspect those pipes, staff the emergency call centers, and maintain the compressor stations, that's all fixed.
So that overhead doesn't magically drop 11.5% just because usage drops 11.5%?
Right. The pipes cost the exact same amount to maintain whether they're roaring with gas or sitting half empty.
Ah, I see.
And that's why regulators establish agreed-upon revenue targets. They need to ensure the company has the liquid cash to safely run the system.
So it's not a penalty.
No, when a severe weather anomaly happens, it creates a mechanical shortfall. Spire didn't lose $28 million because they ran a terrible ad campaign or because a competitor stole their customers.
Right.
It was a structural failure of the historical usage models to cover those fixed costs.
So the Accounting Authority Order, this AAO, is basically a state-sanctioned IOU.
Basically, yeah. It's a specialized regulatory mechanism.
Yeah.
It allows Spire to track that $28 million shortfall on their balance sheet and eventually recover it through future rates.
Which ensures the critical infrastructure doesn't degrade just due to a warm winter.
Exactly.
So it's less of a bailout for bad business practices and more of a true-up to ensure essential services remain solvent.
That's a great way to put it.
But even so, if regulators are going to protect Spire's margins with mechanisms like an AAO, the public needs ironclad proof they're getting a good deal in return.
Oh, 100%.
Regulators won't just blindly approve an AAO if customers are being gouged. To get these protections, Spire has to prove they are bringing a bargain to the table.
The burden of proof is entirely on the utility. They have to continually justify their existence, and more importantly, they have to justify their massive infrastructure spending plans.
And they do that by anchoring their argument in affordability.
Right.
And the presentation leans heavily on data to prove that natural gas is, quote, the affordable choice. Let's look at the equivalent energy costs here.
Let's do it.
In Missouri, the electric equivalent is over 12 cents per kilowatt hour. Natural gas is sitting barely over 5 cents.
It's less than half the price.
Yeah, and in Alabama, it's even more stark. Electricity is over 16 cents, while natural gas is hovering around 6 cents.
So they're framing the narrative clearly, purely on a raw energy equivalent basis. Natural gas is currently a drastically cheaper heating option for the consumer compared to relying on the electrical grid.
But they go a step further than just the raw rates. They calculate what they call wallet share.
Which is a very powerful metric.
It measures what percentage of a median household's income actually goes toward paying the natural gas bill. And the numbers are incredibly small.
What are we looking at?
In Missouri, the average gas bill takes up only 1.49% of the median income. In Alabama, it's 1.39%.
Wow.
Here's where it gets really interesting. Think about your own monthly budget.
Okay.
You likely spend more of your income on a couple of streaming subscriptions or your unlimited cell phone plan than you do to heat your entire house and cook your food for a whole month.
That's wild to think about. It's a highly persuasive metric for regulators. By proving that their service is a negligible fraction of median income, Spire is strategically setting the stage for their capital expenditure plans.
And those plans are monumental. Spire is currently executing an $11.2 billion 10-year CapEx target.
$11.2 billion. That's huge.
Yeah, that is $11.2 billion earmarked for infrastructure over the next decade. 70% of that money is dedicated strictly to safety and reliability.
So we're talking about replacing aging cast iron pipes with modern plastics, installing advanced leak detection meters, hardening the system against threats.
Exactly. Another 19% is carved out for customer expansion. But here's the critical part. They expect to recover about 96% of these investments via what they term constructive regulatory mechanisms.
Things like forward test years and true-ups.
Right.
Let's decode those mechanisms because they are vital to how a modern utility operates.
Let's hear it.
Normally, if a company wants to recover a cost, they have to spend the money first, prove they spent it, and wait for regulators to adjust the rates backward.
Which takes forever.
Yes. A forward test year changes the game. It allows the utility to set customer rates based on projected future costs rather than historical expenses.
Oh, okay. It's like submitting an expense report to your boss before you even take the business trip. You get the budget approved and the cash flowing before you've actually spent the money.
That's exactly it. And the true-up is the mechanism where they reconcile the projected budget with the actual spending later on. It significantly accelerates the company's cash flow.
But is it actually fair to spend $11.2 billion and essentially hand 96% of that bill back to the customers in the form of higher rates?
Well, this highlights the core trade-off of the regulated utility model. That $11.2 billion capital expenditure plan isn't a luxury vanity project.
Right, they aren't building gold-plated headquarters.
Exactly. It's practically and legally mandated for public safety.
Yeah.
Replacing an 80-year-old iron pipe under a city street with modern materials prevents catastrophic disasters. But utility companies don't just have $11 billion sitting in a checking account. They have to raise that capital, deploy it, and then slowly recover it.
And because natural gas is currently so cheap compared to electricity, as we saw with the wallet share data, Spire has what the industry calls headroom.
Yes, the headroom concept is crucial here.
How does that play out?
If your gas bill already consumed 10% of your monthly income, a utility going to the regulators asking to raise rates to pay for new pipes would spark a political and economic firestorm.
People would riot.
They absolutely would. But because the current wallet share sits comfortably under 1.5%, Spire can approach the regulators and argue, hey, we need to spend billions to keep the grid safe.
We can slowly add just a few cents to the monthly bills over the next 10 years, and it will barely register on the customer's wallet share.
Right. The historically low baseline cost of the raw commodity is essentially subsidizing these enormous infrastructure upgrades.
So we've watched them rewire the company to be purely regulated.
Yeah,
We've seen them deploy specialized regulatory tools to mitigate the severe risks of unseasonably warm weather.
right.
And we've seen how they leverage the undeniable affordability of their product to secure guaranteed returns on an $11.2 billion upgrade project.
It's quite the setup.
We understand the strategy. Now, let's look at the ultimate result of all these moves, which is the actual financial payoff for the investor holding the stock.
This is the ultimate stress test. It's where we see if the structural philosophy translates into tangible financial performance.
And looking at the Q2 update, the numbers are highly robust.
Let's hear them.
For the second quarter of fiscal 2026, their adjusted earnings per share, their EPS from continuing operations, is $3.76.
Okay.
That's up significantly from $3.18 just a year ago.
That's a solid jump.
It is. A major driver of that jump was the new Missouri rates that went into effect back in October 2025, which injected an extra $78.4 million into their revenues.
So the regulatory mechanisms are performing exactly as engineered, steadily increasing the top line.
But let's look at how they are actually paying for that massive Tennessee acquisition we discussed earlier.
Yes.
They bought a $2.48 billion company, but they pulled it off without issuing a single share of common equity.
Which is impressive.
Right. They financed the entire deal using $900 million in junior subordinated notes, $825 million in senior notes, and the cash proceeds from selling off their marketing, storage, and Mississippi businesses.
Let's break down that debt stack a bit.
Please do.
Senior notes are traditional debt. They are first in line to get paid back if the company ever goes bankrupt, making them relatively safe for lenders.
Okay.
Junior subordinated notes are further down the priority line, meaning they carry slightly more risk for the lender.
Makes sense.
However, credit rating agencies often view these junior notes favorably, almost like a hybrid of debt and equity, which helps protect Spire's overall credit rating.
But taking on over $1.7 billion in debt notes to buy a company, isn't that just maxing out the corporate credit card to buy a bigger house?
I wouldn't call it maxing out a credit card because a credit card implies revolving, high-interest, unsecured debt.
Fair point.
It's much more like realizing you just received tenure at a government job, and because your future income is now practically guaranteed, you confidently take out a structured mortgage on a new property.
Oh, that makes a lot of sense.
Yeah, they've secured their future revenues through the regulated model, so they know they can easily handle the structured monthly payments of those notes.
And it completely avoids dilution.
This raises an important question about how corporate growth impacts the individual investor.
Definitely.
When a company wants to buy another entity, they generally pull one of two levers. They issue equity or they use debt. If Spire had chosen to issue common equity, meaning they printed millions of new shares of stock to sell to the public to raise that $2.4 billion, they would have diluted their current shareholders.
Because now the corporate pie is cut into thousands of extra slices, making everyone's individual slice smaller.
Exactly. And their earnings per share would likely drop. By choosing not to issue common equity, Spire aggressively protected the value of the shares currently held by their investors.
Smart.
Very. They paired that new debt with the cash generated from unloading their riskier assets. Furthermore, the presentation highlights that they intentionally lowered their FFO to debt target to the 14 to 15% range.
FFO stands for funds from operations, right? Like it's the actual cash they generate from their core business.
Correct. By intentionally lowering that target ratio, Spire is signaling to the market and the credit rating agencies that they are structurally comfortable operating with a slightly higher level of debt relative to their cash flow.
Why would they do that, though?
Because their new, fully regulated business model is so incredibly predictable, they don't need to hoard as much cash to weather potential storms.
Wow. So because they stripped away the volatile, risky parts of the business, they're essentially telling their lenders, our income is so insulated by state regulations now, we can safely carry a larger mortgage.
That's exactly it.
And the proof of that stability is in their dividend. They just increased their annualized dividend by 5.1% to $3.30 per share.
Fantastic.
2026 marks 23 consecutive years of dividend increases. But even more staggering than that, it marks 81 years of continuous dividend payments.
81 years.
Plus, they reaffirmed their long-term target of 5 to 7% adjusted EPS growth. So what does this all mean?
Well, the 81-year metric isn't just a financial fun fact. It's really the thesis of the entire presentation.
Think about the timeline. 81 years of continuous payments means they've been cutting dividend checks since 1945.
It's incredible.
They paid dividends through the aftermath of World War II. Through the heights of the Cold War, the dot-com bust, the 2008 financial crisis, global pandemics.
Yep.
Through every imaginable geopolitical and economic shock, Spire just kept quietly writing checks to their investors.
And the reason they survived all of those historical shocks isn't because they invented some revolutionary new piece of consumer tech that everyone suddenly wanted.
No.
It's because they embedded their business model into the structural survival of modern society. Heat isn't discretionary. It's a biological requirement.
Absolutely.
They have successfully commoditized survival, and they wrapped it in a regulatory framework that guarantees a return. That is what pays a continuous dividend for 81 years.
It truly is a masterclass in risk management. To do a quick recap for you, the listener, Spire is methodically shedding the unpredictable risks of the open market by going fully regulated.
Right.
They're using specialized regulatory tools like the Accounting Authority Order to neutralize the negative financial impacts of unpredictable weather.
Very effectively.
They are leaning heavily on the extreme cost-effectiveness of natural gas to secure the green light for an $11.2 billion infrastructure plan, which they get to pass back to the consumer.
Yep.
And they're using structured debt and targeted asset sales to expand their empire without diluting their stock, rewarding their investors with historic, rock-solid dividends.
They've successfully built a corporate machine designed to smooth out the jagged bumps of reality.
Which brings us back to where we started. That universal desire for a bulletproof financial portfolio. Spire has engineered a corporate structure that is about as close to that holy grail of stability as you can get in the modern world.
It really is.
But looking at all this data leaves me with a lingering philosophical question.
What's that?
If a company can structurally remove the risks of the free market, if they can sell off the volatile segments and use regulatory mechanisms to legally guarantee they recover their money even when the weather doesn't cooperate, are they really a private business anymore?
It's a great question.
Or have they basically evolved into a highly paid private branch of the government? It's something to think about the next time you pay your utility bill.
The line between a public service and a private enterprise becomes remarkably blurred when the financial guarantees are this absolute.
Thank you for joining us on this deep dive into the Spire Inc. Fiscal 2026 update. We hope it helped you understand the sprawling financial gears turning behind the scenes of something as simple as turning up your thermostat in the winter. Keep exploring, keep questioning the world around you, and we'll be back for the next deep dive.